In 2021, a venture capitalist in Palo Alto woke up worth $80 million. By 2023, he was filing for bankruptcy. A Manhattan real estate developer who owned 4 commercial towers saw his entire portfolio go from $300 million in equity to negative $20 million in 18 months. A retired doctor in Florida, net worth $12 million on paper, got a margin call he couldn't meet and lost everything in 72 hours. The wealthy aren't just feeling the squeeze. They're experiencing full financial collapse at rates we haven't seen since the financial crisis. And the weird part? Most of them saw it coming and still couldn't stop it. Here's what I'm going to show you. How a specific financial architecture that worked flawlessly for 2 decades just broke. Why being rich in assets became more dangerous than being poor in cash. And the 3 structural shifts that turned wealth from a cushion into a trapdoor. Think of wealth like a card tower. You can build it really high, but only if the table stays perfectly still. For 20 years, from 2000 to 2021, the table was the stillest it's ever been. Interest rates near zero, asset prices only going up, borrowing costs so low they felt like free money. The wealthy built towers so tall they needed binoculars to see the bottom. Then someone bumped the table. Here's how the basic model worked. You own $10 million in stock. You don't sell it because that triggers capital gains tax, maybe 23%, so you lose $2.3 million right there. Instead, you walk into a private bank. They give you a loan, $4 million, backed by your stock. Interest rate in 2020, 2%. That's $80,000 a year to access $4 million in spending power. No taxes, no sale. You live on the loan, and when you die, your heirs get the stock at a stepped-up basis and pay off the loan tax-free. Buy, borrow, die. It was the closest thing to a cheat code the tax system ever allowed. But that model had one hard requirement. The table had to stay still. Interest rates had to stay low. Asset prices had to stay high. The moment either one moved, the whole thing fell apart. 2022, the Fed raises rates faster than any time in 40 years. Your 2% loan, now it's 8%. That cozy $80,000 annual cost just became $320,000. You're not a venture capitalist anymore. You're a debtor getting crushed by a variable rate you can't refinance out of. And that's escalation 1. Escalation 2 is what happens to your collateral. You borrowed against $10 million in stock. That stock is now worth $6 million. The bank doesn't care about your feelings. They care about loan to value ratios. Your loan was 40% LTV. Now it's 66%. That triggers a margin call. You have 72 hours to either pay down the loan or add more collateral. Most people can't. They're asset rich, cash poor, which is a fancy way of saying they own a lot of stuff but have no money, so they sell. But so is everyone else in the same position. Fire sale prices. You sell $10 million in assets for $6 million. Pay off the $4 million loan. Walk away with $2 million. You just lost 80% of your net worth in a week. Now you're asking yourself, who actually lives like this? Let me give you a real scenario. Names changed, because these people have lawyers. Tyler, a tech executive. 42 years old. On paper, net worth $50 million. In reality, he owned equity in a startup valued at $40 million. A house in Atherton worth $8 million with a $3 million mortgage and about $200,000 in actual liquid cash. He took a securities-backed line of credit, $12 million, at 1.7%, paid off the mortgage, bought a second home in Aspen, put $2 million into angel investments, lived very well. 2022, his startup's valuation got cut by 75% in a down round. His equity, which was the collateral for the $12 million loan, dropped to $10 million. Margin call. He didn't have the cash. Couldn't sell the equity because of lockup restrictions. The bank foreclosed on the securities, sold his shares at the worst possible time, and demanded he cover the shortfall. Tyler went from $50 million to effectively broke in 4 months. This is where it gets really interesting. Because you'd think, okay, that's tech. Startups are volatile. What about real assets? What about real estate? Worse. Much worse. Office buildings used to be the safe play. Boring, steady, reliable. You buy a 10-story office tower in Dallas for $80 million. 70% of that is a mortgage, $56 million. You put down $24 million. The building is fully leased. Rent covers the mortgage and gives you $2 million a year in cash flow. Beautiful. Then 2020 hits. Remote work becomes permanent. Your tenants don't renew. Vacancy goes from 5% to 40%. Rent revenue drops by half. You can't cover the mortgage anymore. But here's the real problem. That mortgage was at 3%, locked in for 10 years. It matures in 2025. You need to refinance. But now rates are 7%, and the building's value dropped from 80 million to 30 million because nobody wants empty office space. The bank won't refinance 70% of 30 million. They'll do maybe 50%. That's 15 million. You owe 56. You need to come up with 41 million in cash. Where do you get 41 million? You don't. The building goes back to the bank. Your 24 million down payment, gone. There's $4.5 trillion in commercial real estate debt maturing between now and 2027. Most of it office buildings, most of it underwater. That's not a crisis waiting to happen. It's happening right now. Now you might be thinking, okay, but rich people diversify. They don't just have one building. Sure, but diversification doesn't help when every asset class breaks at once. Stocks down, real estate down, crypto, if you were into that, down 90%. Startups, let me tell you about startups. In 2021, if you were rich and not investing in startups, people looked at you like you were financially illiterate. Everyone had a fund. Everyone had a syndicate. Minimum checks were $250,000. The pitch was always the same. This company is going to be the next Uber. Pre-revenue, sure, but the TAM is enormous. Total addressable market. Investors love TAM. Sounds scientific, means nothing. So Ian, another real person, different name, invests $1 million across 10 startups, 2021 valuations, AI companies, mostly. Couple fintech plays. By 2024, here's the scorecard. 3 companies fully dead, returned 0. 2 companies are zombies, still alive, but can't raise more money, can't exit, just burning cash in purgatory. 3 got acqui-hired, which is a polite word for failure. The team got jobs, investors got nothing. 1 did another funding round, but at a 70% lower valuation, so Ian's shares are worth less than he paid. 1 is being investigated for fraud. And one is actually doing okay. But Ian can't sell because there's no market for private shares, and the company says an IPO is, quote, several years away. His $1 million in investments is now worth maybe $80,000 on paper and 0 in his bank account. But here's the fun part. He can't even write off the full loss. Tax code says you can only deduct $3,000 in capital losses per year unless you have gains to offset. Ian has no gains. So that $1 million lesson gets deducted at $3,000 per year for the next 333 years. Hope he's into cryonics. The theme here is the same. Illiquid assets, no cash flow, high costs, and a system that was built for stable conditions experiencing the most unstable conditions in 50 years. Let's talk about rich people inflation. The CPI, Consumer Price Index, says inflation is 3%. That's for normal people buying milk and gas. Rich people don't live in that economy. Their inflation rate is 15 to 20% annually. Private school, 60 to 70,000 per kid per year now. Used to be 35. Home insurance in Florida, if you're on the coast, tripled. Full-time household staff in Los Angeles or New York. A nanny is now 90 to 120,000 a year. A private chef, same. Personal security, which more wealthy people feel they need now, starts at 200,000 annually. Property taxes in high net worth towns like Greenwich or Atherton, 50 to 80,000 a year on a house, and rising. Maintaining wealth got way more expensive, right? When wealth itself started shrinking. Then there's divorce. Gray divorce, they call it. Over 50, splitting up. The rate has doubled since 1990. And when you divorce at 55, after building a business together for 30 years, it's not a clean split. Picture this. Peter and Paula, married 30 years, combined net worth 40 million. Sounds great, except it's not liquid. 15 million is Peter's stake in a private equity fund that doesn't allow withdrawals for another 3 years. 10 million is Paula's medical practice and the building it's in. 8 million is real estate, 2 rental properties that are underwater on their mortgages right now. 5 million is retirement accounts they can't touch without penalties. 2 million is home equity. Actual cash, 300,000. They decide to divorce. The court orders a 50-50 split. Sounds fair, but you can't split a medical practice. You can't split a private equity stake. So they hire forensic accountants, appraisers, divorce attorneys at $800 to $1,000 per hour. 2 years later, they've spent $2.4 million in legal fees. They're forced to sell the rental properties at a 30% loss because the court won't wait for the market to recover. Paula has to buy out Peter's half of the practice by taking on new debt. Peter has to liquidate part of his private equity stake at a 40% discount to a secondary buyer because the fund won't let him withdraw. After taxes, after fees, after forced sales, their $40 million turned into $15 million each. Except it's not even 15 clean. It's 15 with new debt, new tax bills, and most of it still illiquid. Both of them drop tax brackets, both downsized. This happens more than you think. Now, here's the problem. Governments are paying attention. They're broke too. Ran up massive debt during COVID, need revenue, and they just installed a new system. It's called automatic exchange of information. 100 countries share banking data now. You can't hide money in the Caymans anymore. The IRS knows, so they're coming for wealth taxes. Unrealized gains taxes. Imagine you started a company. It's worth $100 million on paper. You own 80%. That's $80 million in equity. You haven't sold a share. It's all unrealized. Government says you owe tax on 25% of that gain. That's $20 million in gains. At a 40% tax rate, you owe $8 million in cash. This year, you don't have $8 million in cash, so you sell shares. But selling dilutes you. You lose control. Or you take on debt to pay the tax, which puts you right back in the trap we just described. Some people try to run, move to Puerto Rico, renounce citizenship. The IRS has an exit tax. If you're worth over $2 million and you leave, they treat it like you sold everything the day before you left and tax all the gains. You're still trapped. Here's what starts happening. Desperation. I've seen this pattern up close, not personally, but through court records and insider accounts. A fund manager is down 60%. Redemptions are piling up. He can't admit the fund is cooked because his entire social circle, his reputation, his identity is built on being the successful guy. So he starts a side fund, promises higher returns, uses new investor money to pay old investors. Classic Ponzi, buys himself 6 months, then it collapses. Prison. Or the real estate developer who's underwater on 4 buildings, can't make payroll for his management company, starts commingling funds, takes money from property A to cover costs on property B. It's fraud, but he's telling himself it's temporary. It never is. The really dark part? Some don't even try fraud. They just quit. Suicide rates among high net worth individuals during financial crisis periods spike. It's not talked about because their families bury it, but the pattern is documented. The psychology is predictable. Identity built entirely on wealth. Wealth disappears. Identity shatters. No way out that doesn't involve public humiliation. To be fair, not every rich person is going broke. The ones surviving have 3 things in common, and this is the only part that matters if you're trying to build or protect wealth. 1. Liquidity over assets. They keep 20 to 30% of net worth in actual cash, or things they can sell in 24 hours. Not tied up, not locked, liquid. When everyone else is selling in a panic, they're buying. 2. They don't borrow against appreciating assets. No securities-backed loans, no mortgages on investment properties they can't afford to lose. Debt is only used for cash-flowing assets, and even then, at conservative ratios. 3. They live below their means, even when they don't have to. The doctor making $2 million a year, who still lives like he makes $300,000? Sounds boring. It's also why he's still rich in 10 years when his peers are liquidating. The buy, borrow, die strategy worked in the zero-rate world. That world is over. The people getting destroyed right now aren't stupid. They're playing by rules that changed overnight. The system didn't warn them. It just switched off. If you're building wealth now, the lesson isn't that being rich is bad. It's that being illiquid is suicide. Cash is the asset. Liquidity is the strategy. Everything else is just hoping the table stays still. And the table is never still for long.